Today's podcast is brought to you by Freetrade, the commission-free investment platform. Head to freetrade.io/PensionCraft and get started today. Do the hard laws of thermodynamics apply to your money? What can avalanches, boiling water, and quantum mechanics teach us about markets? Today we explore where physics meets finance and what it reveals about volatility, crashes, and portfolio decay.
So can we build a portfolio to survive the laws of nature? And in today's dumb question of the week, what should you study if you want to work in finance? All right, let's get into it. So I hope you all listened to our episode last week with Tyler from Portfolio Charts, which I think was really informative and we've had a lot of good feedback. But during that episode, Romin, there was a bit of a to-do between a physicist, you, and an engineer about the relative value of these two disciplines. So I thought, Romin, you've given us so much over the years, so much valuable content. Let's let you indulge yourself just for 1 week, and we're going to do the physics of finance.
Woohoo! I think unusually I will be steering this episode when it comes to the topics, and then your job is just to keep me under the cosh slightly if I go off on a tangent.
Yeah, I'm fine with that, so long as you don't make me relive any traumatic experiences from my physics A-level more than 20 years ago. Okay? You're the PhD here.
Oh, I loved my physics lessons. That was an absolute joy. So let's kind of turn to some of these metaphors. And I mean, some of these links are a bit tenuous, but I think some of them are just spot on. So let's start with one which I think is really interesting, which is phase transitions. Now, if you're not familiar with this idea, thermodynamics is the idea of how you can go from the molecular structure of the universe to bulk properties like pressure for gases, temperature, and that link is largely mathematical. And it seems quite theoretical, but it's a really deep part of physics. So let's use a concrete example that we've all got experience of. You take some ice out of the fridge and gradually it melts. Now, if you could stick a thermometer into the ice while it was melting, there's a kind of remarkable fact, which is the temperature never changes. It's always at zero. So how is that possible? You know, we're adding energy to the system as heat flows in from the surrounding environment, and yet its temperature doesn't change.
That's how we can enjoy our Jack Daniels.
Indeed, it stays cold, the ice in our drink. But what happens here is that there's a really subtle and invisible change going on. Normally, temperature is how much atoms are wobbling. So if they're moving a lot, if they're moving very quickly, that's high temperature. And then if they're not moving at all, that's called absolute zero. That's a temperature of minus 273 Celsius. And you can't get colder. If things stop moving, that's as cold as it can get. So there is an absolute scale here. But when we're talking about ice, what's happening is as we feed energy into the system of ice, we've got all of these bonds holding the water molecules together really tightly as a solid. And as more energy flows in, all of the energy is being used to break those bonds. So it's not going into making the water molecules wobble more. So the temperature is not increasing. But then the interesting thing is, once all of the ice is melted, there's no more structural change going on inside the solid. At that point, you can finally now start to increase the temperature of the liquid, which is now being formed, and the temperature can increase above zero.
Or you can put more ice cubes back in your drink, right?
Which is what we all do, of course, yeah. So you're probably thinking, well, what on earth has this got to do with finance or investing? And I think the analogy here would be something to do with crises and crashes. So, for example, you might get all of this news flow, which is negative. You've got things like tariffs, you've got things like trade disputes, there are things like concentration in the US market. And it just seems as if there are so many negative news stories, and yet markets are completely ignoring it. How's that possible?
So to use your analogy, there's a lot of energy going into the system here. The media is in a frenzy, yet markets are still at all-time highs.
Yeah, there's no effect, it seems, until that critical thing happens. And then we undergo this phase transition, just like the ice cube melting. We've gone from one system in which everything seemed to be absolutely fine 1 minute to one in which everyone is absolutely panicking and freaking out. Markets are tumbling. All the narrative has turned negative. And it just seems as if we're in a completely different world than we were just a day ago.
Could I say, Roman, that the bonds have broken? And no one likes that, do they? Both in physics or in finance.
Oh, that's very good. Yeah, and particularly for me, because I love bonds.
But are you talking about kind of liquidity crises here?
Yeah, certainly liquidity is part of it. And remember where liquidity comes from. It's the ability to sell things quickly in open markets. The reason why you can do that is because market makers' jobs are to always be willing to trade. They may, of course, alter their buy and sell price. That's their bid-offer spread. But they've always got to be willing to trade. And they become much more reluctant to trade when we undergo this phased transition to chaos. And that means the bid-offer spreads widen. And then, of course, if we want to trade, it's going to cost us more to sell whatever it is we're selling. So that's why psychologically, the entire market's undergone this phase transition. And it is about psychology. It's not so much about physical things. All of the servers, all of the mechanical plumbing which makes the system work is still in place. It's the people in the equation which have undergone the phase transition.
I like this analogy, Robin, but it's a little bit back to front, isn't it? Because with the drink, we're saying it's gone from frozen ice to liquid. And here we're saying the market's liquid and it's suddenly gone frozen. And that's when panic ensues and you get a crash.
Yeah, maybe a better analogy would have been to go from liquid to gas, because there, everything flies apart when you go from liquid to gas. So maybe that would have been a better phase transition. But I like the one with ice because it's always surprising that it doesn't increase in temperature. I was always shocked by that as a boy.
So that's a pretty good metaphor from physics for how markets work and how crashes happen. Have you got any more market crash analogies for us?
Yeah, and it's kind of interesting because this one wasn't really around when I did physics. A lot of the physics that we used to do when I did my degree, and this was roughly 1990, a lot of it was from 1900. And it seemed like all of physics was pretty much sorted out by 1900. Einstein had worked out general relativity, so a lot of the modern physics had been done. Particle physics was new. There was always exciting stuff coming out of CERN. They'd discover a new particle, or they'd be looking for particular things which might change physics. And there were hints at things which weren't quite working with the standard model.
Yeah.
So we knew that galaxies should actually fly apart. There's some kind of missing mass holding them together, which is a pretty big problem in physics.
Physicists just say dark matter and I hope that solves everything. That's what I think.
That's right. And no one knew what this dark matter was, so that was a kind of conundrum. So it wasn't the case that physics had been solved. It's just that we didn't learn the kind of exciting stuff. But the exciting stuff at the time was to do with things like self-organizing systems, which doesn't sound like physics, but it turns out that it is deeply embedded in physics. And it starts, as physics often does, with something which seems like a ridiculously simple analogy, which is to do with sand piles. And it reminds me of when my kids were in nursery. One of their favourite toys was this sandbox where the kids would go in and they'd kind of make a mess. And it was great fun for them, not so much for the parents.
Still popular today, Roman. It's timeless, a sandbox.
But it was great fun playing with sand because you could pile sand up. And what was weird about sand was that you couldn't pile it very high. Once it gets to a certain height, it just collapses under its own weight and just goes into this fairly standard shape.
Yeah, what's that about, Roman? What is that about?
So there's a whole model about this in physics. It's called the abelian sand pile, or if you want to make it fancy, the Tang-Weissenfeld model. But the idea here is that if you've got this system where you're piling grains of sand onto a heap of sand, of course, eventually you get a pile, but then it reaches this thing called a critical state. And just adding one grain makes the pile collapse. And what's weird is if you've got 2 grains of sand that you could add, where you add them doesn't matter. It always ends up in the same end state.
So in layman's terms, it sounds to me that you're talking about an avalanche.
Yeah, exactly. And again, coming back to things which trigger one of these big sell-offs in markets, it's quite similar to this idea of critical state, where you get loads of these negative news stories. Non-farm payrolls is weak. We've got higher inflation data than we expected. The Fed's hinting that it might start hiking again. All of these news stories seem to, on their own, be enough to maybe make markets crash, but nothing happens. And then suddenly a news story comes along, and that seems to be what triggers it. So it seems almost random what it is that tips things over into this new state.
But it is almost random, isn't it? Because it's not that news story itself that really was enough. It just happened to be the straw that broke the camel's back, the last grain of sand on the pile.
Yeah, another way that people describe this is the butterfly effect, where the idea is that if you have a chaotic system, if you have a really small change in the initial conditions, it can make a massive effect on the overall system. So if a butterfly in Australia flaps its wings, you can get a hurricane on the equator somewhere, which is far away. And markets are very similar to that. And that means that if you're trying to predict what is going to make markets sell off, it's going to be impossible, because it might be that tiny butterfly effect.
You know, it also reminds me of the fact that markets can only go so far away from their sort of normal state before a collapse becomes inevitable, right? That pile can only get so big. Valuations can only get so stretched before it'll just collapse under its own weight.
But also, the analogy from the sand pile is a good one, because for each individual grain of sand, you can't predict whether that's going to be the one that does nothing or it's going to be the one that triggers the avalanche. So timing is really critical here. You can't predict the timing. It is inherently unpredictable. And that's the message I take home from this idea of self-organized criticality.
And talking about unpredictability and uncertainty, I see the next thing on your notes looks intriguing. It says quantum mechanics, the Heisenberg uncertainty principle. Now, this sounds like some sort of real Nobel Prize winning stuff here.
Yeah, I mean, if there's one topic that really confuses people, it's quantum mechanics, because a lot of physics is intuitive. You know, it's about how balls move, it's about how planets move around the sun, or it's about things like temperature, which we all perceive. And it's pretty intuitive. Whereas quantum mechanics is not intuitive. It is really, really weird.
Can I push back on that slightly? Like, the planets moving around the sun is not that intuitive. People didn't work that out for quite a long time. Didn't they think we were sat at the middle of the universe?
Yeah, but it's still this idea of balls, you know, rotating around one another. Yeah, gravity's weird, I'll give you that. But whenever we step outside our normal everyday experience, that's when physics starts to tell us about things and things become unintuitive. If you travel close to the speed of light, if you look at matter on a global scale or on a subatomic scale, things get weird.
And so how weird are we talking here?
Well, very, very weird, because if we're talking about quantum mechanics, just throw all of the ideas you've got about the nature of solid everyday objects out of the window. Instead of things having a position and being certain, you know, if you look at a ball sitting on a desk, turn away and then look back, it'll still be there.
You haven't got toddlers, have you, Roman?
I have got a cockapoo, however, and all sorts of things move around our house inexplicably, mostly slippers. But in quantum mechanics, all possible things happen. So let's say you throw me a ball. The ball doesn't follow a single trajectory. It follows all possible trajectories. Sometimes it does a loop-to-loop. Sometimes it goes to the other side of the room and then appears in my hand. And each of those paths is weighted by its energy. It's free energy. But that's what's weird about quantum mechanics. All possible things happen, but some things are more likely than others. And we describe this as a wave function. The wave function tells you what things are most likely and which are least likely. And instead of following hard rules, everything can happen. And this is how quantum computing works. You've got a computer which considers all possible solutions and considers them in parallel. And that can really speed things up. So you can harness this quantum uncertainty in order to engineer things which you want. But let's come back to the idea of uncertainty. Another really weird thing about quantum mechanics is that if you observe the system, it changes the system. And this isn't just some kind of, if you observe it, you might prod it. No, it's not that at all. The actual act of observing where an electron is, say, affects the quantum system such that its behavior is different. And a really nice example of this is Schrodinger's cat, where you've got a cat sitting in a box, the box is sealed, you've got a radioactive source, and if there's a detector, and the detector detects a particle which is decayed from the radioactive source, the cat dies. Now, before you open the box, the cat's both alive and dead. You don't really know, and that means it's in both states. It's an alive, dead cat.
It's like before you open your broker account, you're like, your portfolio could be good or it could be running to the ground.
It's precisely like that, and we'll come back to that. But then once we observe the system, you collapse the wave function, that's what it's called. And by observing what's happened to the cat, you force the system into one state or the other. So again, how does this have anything to do with investment? Well, I think here the idea is that if you monitor your portfolio, then you're introducing noise into this system, because the more volatility that you see, the more likely you are to actually fiddle with what's in the portfolio. So the act of observing what you own and what it's worth itself affects your long-term returns.
Because it changes your behavior.
Because it changes your psychology and your behavior, exactly.
It sounds tenuous, but I think there is a real grain of truth in there. That if you monitor your portfolio every day, every week, and you see big swings, it's not unusual for the stock market to go up or down 2 or 3% a day, or lose 10% over a couple of weeks. But if you only look at it every year, you're most likely to see something closer to that slow drift upwards, albeit still with big down moves occasionally.
And the worst thing that this can do is to stop you from investing, because if you're looking at the daily changes and you see markets going down, and you've got your monthly contribution into your ISA, and you think, well, I'll just hold off for a few more days. Well, maybe you won't ever contribute that money. So holding money back from the market, putting too much into the market, all of this is driven by things like FOMO. You're watching markets go up really quickly and you want to get more upside. Or you're watching markets go down and you want to avoid loss. All of that negatively affects your return. With holding money from the market, taking too much risk, too little risk, all of that will be a problem longer term. And a lot of it stems from observing markets too frequently. And if you haven't come across it, there's a really funny article by Cliff Asness, who's the co-founder of AQR Capital. And basically everything in finance he's already thought of. The equivalent in physics would be Lord Kelvin, who basically worked everything out. You probably guessed from his name, he came up with the temperature scale in physics, the absolute temperature scale. But Cliff Asness is the Lord Kelvin of finance. And he had this hilarious article, which is called The New AQR Smooth Fund. But the joke is that he's going to take one of his existing portfolios, one of his existing funds, and simply not report the price and the value of the fund, except for maybe once a year. And he says it's simply a superior offering to anything we've done before. It provides the same long-term attractive expected returns as our other offerings, yet at a fraction of the volatility, with very few to no embarrassing losses.
Sounds like he just wants to run a private equity fund, doesn't it?
That's the joke. He's saying that if he makes it like private equity, it's just a normal fund, but you just observe the price every year or so. But then he goes on to say, of course, the same long-term returns, but delivered with way more stability, comes at a price to you. These funds will not be offered at competitive fees, as is our norm, but rather will feature the traditional 2 and 20 fee model. And we may charge some fees based on capital you have not invested with us yet, but expect to later. So he's saying, we'll just whack up the fees because we're not observing the price and the volatility looks lower.
So hedge fund managers have really embraced this kind of Heisenberg uncertainty principle. Don't look too closely.
But even better, with private equity, the valuations themselves are based on what they expect they should be. because you can't really value some of the illiquid stuff which they own. So a lot of it is marked to model, that's what they call it, where they mark their own homework, which is very dodgy.
So I think you've covered some really nice analogies so far. Some of them quite direct, some of them more tenuous. I mean, quantum mechanics always bothers me. Does it not annoy you, Romin, that the universe seems to say just looking at something changes the reality?
I love that. When I learnt about Bayesian statistics, where statistics is subjective, that all made sense as well. And there is a kind of deep analogy between the two.
Whenever I hear this sort of quantum effect thing, it just makes me think we're living in a simulation, because that's how video games work, right? They don't render something until the player looks at it. What do you think about my crazy speculation?
Yeah, sometimes it feels like that, how you construct reality. But that's what physics is. How do you construct the world we see based on this really weird stuff which we don't see and which we wouldn't have known about if we hadn't had physics in the first place? It really has expanded our minds about how things work.
Well, after the break, we've got to find some way of getting back on piste here and talking about investing, all right?
This episode is sponsored by Freetrade. Right now, you can get 2% cash back when you transfer £10,000 or more in pensions to Freetrade. Switch to one of the UK's cheapest SIPP providers. With a Freetrade pension, there's just one flat fee, zero commission, and access to over 6,500 stocks, bonds, and funds, all in one easy-to-use investing app. Visit freetrade.io/PensionCraft to start your transfer. Capital at risk. Other charges may apply. SIPP eligibility rules and terms and conditions apply. Cashback is capped at £1,000 per customer, and the offer ends 31st of December 2025.
Okay, so in the first half, Romin, you bamboozled us with thermodynamics, sand piles, and quantum mechanics. What have you got lined up for us in the second half?
Oh, it just gets better. So let's start off with the idea of someone like Marconi setting up the first transmitter where he was going to send a signal across the Atlantic. So how do you do it? How do you send a radio signal much further than anyone had sent it before? Because this was a step from something which essentially was a parlor trick to something that would completely transform our world into one in which you could send signals across the world at the speed of light, which is the world we're used to now, of course. But how did he do it? Well, it's all about signal and noise. If you've got a radio transmitter and you double the distance from the transmitter, there's an inverse square law where the energy falls off really quickly. So that means to send a signal to the US, you have to boost the power that you're sending. So the signal gets stronger compared to the noise that you get if you just listen to a radio transmitter with no signal. And you've probably heard a radio that's not tuned. It just goes that white noise that we're used to. And that's what you've got to beat. You've got to beat the noise. So there's this concept of signal to noise ratio. How do you beat the noise? By boosting the signal. And how do you sift through the noise in order to find that signal?
Now, I've no idea how anyone solved that problem, but thankfully someone did, because we can talk to people in New York.
I guess another part of how he did it was partly to do with power. He had a big transmitter and he had a lot of energy he put into the transmitter. But also he used a fairly narrow bandwidth, so a specific frequency of radio wave, so that the person at the other side of the Atlantic knew where to look for the signal. By filtering out the frequencies which they weren't going to transmit at, again, they could boost the signal to noise ratio. And I think the analogy with investing here is a good one, which is a lot of investing, the thinking that goes behind it, is about sifting out that signal from the surrounding noise.
And there's a lot of noise, isn't there, investing? Everything really in the short term is noise. The daily price moves, that's just noise, largely. I don't think you can really tease any signal out of that. And all of the news flow around it is probably 95% noise. Even the earnings themselves are noisy, aren't they, quarter to quarter?
Yeah, less so, I'd say. I'd say that's less noisy than looking at daily prices. And yet some people still think that by looking at the daily prices, you can somehow figure something out about which way markets are moving. But it's like looking at a coin flip. You're not going to be able to guess what happens in the future based on very short-term changes. So daily prices are almost all noise. Quarterly earnings, maybe 50-50 noise signal. And then if we're looking at 10-year trends, I think that's much less noise, 5% noise, 95% signal.
So it's making sure you look at the right things, right?
Exactly. And that long-term trend is what you buy when you buy a global index fund, say. And that's very likely to work because historically, that's what it's done. It's filtered out the noise. Another interesting fact is that the timescales that you look at in finance are another way to filter out the noise. If you look at markets day to day, it's completely dominated by volatility. That's because volatility scales as the square root of time. Whereas if you look over very long periods of time, return, which is this upward drift of equity due to increasing profits, that dominates volatility, and volatility becomes decreasingly important. So if you imagine a creature which only looks at markets every 10 years and one which looks at markets every minute, they'll see completely different markets. One will see a completely random universe. So that's the short-term creature. The longer-term creature will see things which steadily move upwards with various fluctuations which are much smaller, but drift is what they'll see.
And this is presumably why day trading is almost impossible, because you're just gambling on noise.
Yeah, and again, the psychological effects here are important. If you show people random noise, they'll see patterns in it.
Yeah.
So this is Burton Malkiel's book, A Random Walk Down Wall Street, where he asked students to simulate a stock price. And it started out at $50. And then every day they flipped a coin. If it's head, the price went up by 0.5 point. Tails, it went down by 0.5 point. And then he plotted those series, the randomly generated ones, and gave them to people who are chart readers. So these are called chartists. Now, even though it was completely random, of course, they still found patterns in the data which made them think they could predict future movements. But of course they couldn't. They were saying, yeah, buy, it's an uptrend, or sell now, it's about to turn. But that was just nonsense. So we impose order even when there isn't any. So even if we were looking at the short-term fluctuations, we might think we could see patterns in it. That's just what our brains are designed to do. But in reality, you can't predict based on that.
Yeah, we're pattern matching creatures, really, aren't we? I like this whole idea of the signal versus noise ratio. And it plays a big role in this podcast, actually, because I obviously edit the audio. And so many times I have to try and filter out, Teddy's heavy breathing, rustling around, you just shuffling in your chair with a filter. So as an investor, you almost need to install a kind of low pass filter. So the high frequency noise just can't get past it.
And I have to say, some of the podcasts and some of the video content on YouTube is also noise. People talking about how awful things are, about how markets are about to crash, when you don't know when that's going to happen. So I think filtering some of that out also isn't a bad idea.
So if that's all the stuff you really shouldn't pay attention to, what should you be paying attention to? What can you actually control here?
And that's the important thing. It's things that are under your control. The randomness of markets, you'll never be able to control that. But things which affect the cost of investing, there you do have direct control. And that might be the platform that you use. Some platforms are a lot cheaper than others for exactly the same portfolio and exactly the same trades. It might be the funds that you choose. Some are very expensive and suck out some of your returns long term for certain. And it might be financial advice. If you're getting financial advice every year and that's draining 1-2% of your pot every year, well, that may not be worth it. It may be for some people, but for others, I think it probably isn't. But the analogy here, I think, would be something to do with drag in aerodynamics, where if you've got something moving through the air, there's actually a force that opposes it. And that's because you're having to bump all of those air molecules out of the way as you move. Now, if you've got laminar flow, where it's smooth, it scales as the speed of the moving object. But if you've got turbulent flow, which is what you get at a reasonable speed, suddenly it starts scaling as the square of the speed. So double your speed, twice the amount of energy needed to keep going.
And now my Jack Daniels is all over the floor of the cabin. Ice just melting into the carpet.
But the analogy here is a good one, I think, because it tells you about how drag, which is transaction costs and taxes, can act as a negative impact on your long-term growth. So really it's about finding an aerodynamic way of investing, which doesn't have as much drag for the same velocity.
So let's say we've got this aerodynamic portfolio. Fees are low, taxes are low, we're soaring, we're flying through the air. Is there anything else that can drag us off course?
Yeah, I think here the concept of entropy, which is the mathematical description of disorder, is a really important one. One of the weird things in thermodynamics is that the uncertainty or the disorder of systems almost always increases. Ultimately, this is going to result in the heat death of the universe because disorder is heat and everything we do generates heat. But I read this book as a kid, and it was just a tiny little book in the physics library at school, and it was called What is Life? And it was written in 1944 by Schrödinger, who's one of the founding fathers of quantum mechanics, and it had some surprising things in it. But the key idea here is that living systems are not disordered. What they seem to do is to suck order out of their surrounding environment to create an ordered system inside themselves. And to do that, they take energy out of the surrounding environment. That might be sunlight, it might be chemical energy by eating things. But he called that negentropy, which I think is a lovely little phrase. But in this way, life creates order from this essentially disorderly universe, which I think is a very beautiful way of describing it. You look at a jungle, you look at a really rich ecosystem, or even just take a slice through a leaf and look at all those beautiful structures inside the leaf.
Yeah, I once heard Jeff Goldblum, surrounded by dinosaurs, saying a similar thing to Schrödinger there.
I love that book, and I think that might be one of the reasons why I decided to study biophysics for my doctorate. But that concept of what is life is really an important one. Essentially, cells are just these bags of fat that separate the surrounding seawater from the chemistry inside the bag. But that's not enough, because if that's all you have, well, you've just got a bag of seawater. You have to actively manage the environment inside the cell. And so we have all of these proteins which are specialized in pumping things across the cell membrane so that there's this voltage difference between the inside and the outside. And one of the things I learned as a biophysicist is that's what characterizes life. When a cell dies, those pumps stop working, and then the inside and the outside become the same thing. So this idea of using energy to go across this chemical gradient is really key to life.
So how does this idea of entropy and the fact that systems, if you don't step in, are going to slowly tend towards disorder, how does that apply to investing and our portfolios?
Well, normally what I say is don't fiddle with your portfolio. And it's good advice because if you do, you usually underperform. However, if you do leave a portfolio and don't rebalance it, what gradually happens over time, and this is a mathematical certainty, is that certain aspects of the portfolio, certain allocations, simply become massively dominant. So let's say you've got 60% equity, 40% bonds. You don't touch it for the next 20 years. Well, equity grows faster than bonds. So what was a 60-40 will end up as a 90-10 if you don't actively step in to rebalance the portfolio. So certain things do require maintenance, and not doing anything for a very long period of time is a problem. Entropy will eventually enter the system, and you'll end up with something which is not what you wanted.
Woo! I think we've made it, Ron, through all your analogies. And we've learned a lot about physics, about investing, about life. Any closing thoughts for us to bring this lecture to a close?
Yeah, I think what I've learned from having a background in a very technical subject is that no knowledge is ever wasted. All the things which you learn, even if it's nothing to do with what you're currently doing, really feeds in to whatever you choose to do. It's really worth studying a discipline and really getting into it in depth because you'll find it useful later on in ways you would never have imagined.
I think that's right. There's all sorts of connections which you never really envisage at the time. But I've got a question for you, Roman. Do you plan to send this episode to Tyler just with a sort of middle finger emoji? Is that your plan?
No. So you've heard my very idiosyncratic perspective on investing today. But I think the benefit of an investing community is that you see it from many people's perspectives. And if you wanted to join our PensionCraft community and learn from everyone, then you can do that really easily. Just go to pensioncraft.com/membership to learn more.
Okay, today's dumb question of the week is, what should you study if you want to work in finance? You came through a bit of an unusual route, didn't you, Robin? Studying physics? Or were you surrounded by physicists when you worked in investment banking?
Yeah, I think for different parts of the bank, you have different specialties. For the numerical bits of it, if you're a quant, you're almost certainly going to come from a maths background, a physics background, because you've got the maths necessary to analyse what's going on. But there were incredibly diverse members of the bank that I was working for, both banks, in fact. A lot of people came from history. They'd done history degrees. A lot of people came from humanities. But I'd say what really marked people out was the ability to learn. If you're not willing to learn, you just cannot survive in that environment. If something has to be explained to you twice, you're out. That was basically the way it worked. And it was brutal. It was really awful. But, that doesn't really restrict your background. For example, if you've done an English degree, you're perfectly capable of learning and learning quickly. So that's why I think it's good not to be too prescriptive when it comes to choosing your degree, even if your ultimate goal is to move into finance.
So it's not the case that you're best off choosing economics or something like that?
Many people do, and I think that's increasingly the case. I think it used to be the case that you could do a humanities degree and it would be quite easy to get a job in investment. A lot of people used to be ex-military, and that would be the way into it. But
really?
I think things have... Yeah. A lot of the language that's used on the trading floor is still oriented towards that. And of course, it is very male-dominated still.
Presumably, wherever you come from, whatever discipline, there are things you need to pick up along the way. Like, I guess for most of investing, it's hard to make sense of stuff if you don't have some level of understanding of accounting and how that works.
Yeah, if you're completely fazed by numbers, it's not going to work for you. You've got to have some numerical ability and not be scared to really dig into the weeds when it comes to a spreadsheet. But beyond that, unless you want to be a quant, I think you don't really need to be a mathematical genius. You don't need to be Einstein in order to make a really successful career in finance.
A lot of people came from computer science, right? I've heard the criticism of the UK economy that we produced great computer scientists and then they got sucked into working in the city and so didn't, come and found the tech companies that we maybe would have had otherwise.
Yeah, I think that's true. It does suck in a lot of talent. And maybe that's a bad thing. Maybe it would have been better if a lot of the scientists had gone on to work in fundamental science. But another problem, of course, is money. Because if you do have that mathematical ability, and the pay as a postdoc is so dreadful, which it was, well, of course, you want to cash in your degree and make real money with it. But what often happens is people, after they've had their career in finance, then go back to that discipline.
It's like Brian May from Queen. He toured the world and then he went and got his PhD in astrophysics.
At Imperial, it has to be said. Yeah.
I love Brian May.
But it's having that intellectual curiosity, the ability to learn, the ability to adapt, but also to have that focus. You've got to be able to focus on the task at hand. And ultimately, that's about a focus on markets and on clients. And I think that's what's really important to succeed in finance. But what I did learn working in investment banking was that the people there are not really nasty, selfish people. It's not like the Wolf of Wall Street. They're incredibly talented, diverse, interesting people with really interesting backgrounds, often nothing to do with finance, and yet so interesting to talk to. It was really intellectually stimulating, really great minds, and of course, great salaries.
Thank you for joining us for Many Happy Returns. Keep sending us your questions, no matter how dumb, at mhr@pensioncraft.com.
And do remember to check out PensionCraft.com for all the information about our membership, courses, and investment coaching options.
Many Happy Returns is a PensionCraft production, co-hosted and executive produced by Romin Nakiza and Michael Pugh. This podcast is for informational and entertainment purposes and is not financial advice. We do not provide recommendations or endorse any decision to buy, sell, or hold any security. We cannot be held responsible for any actions listeners may take, and investors are encouraged to seek independent financial advice.